Hello and welcome to Beneath the Surface with Scott Gibson. Scott recently sat down with Jim Letourneau of the Big Picture Speculator. He is telling us about the risk-opportunity ratio for uranium stocks and also why we all have to understand that it takes step by step to build a mining company. Enjoy!
Hi, my name is Scott Gibson with Kitco Gibson Capital. I'm here with Jim Letourneau of the Big Picture Speculator. Thanks for being with us, Jim.
Pleasure as always.
We're here in Vancouver at the Cambridge House Resource Investment Conference. What's your thoughts on the conference so far?
This has been one of the most biggest conference, very well organized. There's a lot of educational opportunities for people, and just the sheer number of exhibitors. It's like one of the biggest shows in the world for mining.
And you gave a presentation here. You're talking about hype curve investing.
Yes.
Why don't you tell us a little bit about that?
Well, hype curves, I think if you invest in junior mining companies, you're probably already familiar with it, but you might not think about it in that way. In that discovery, initial burst of share price activity is usually followed by a very big pullback. And at that point, we sort of separate the good companies from the bad companies. And if it's a good company, it'll be around for another 5 or 10 years. They're less risky after the share price collapses than when, they're less risky after the fact than going into the hype. And we've seen, my favorite example is uranium stocks, because they were massively hyped, and we went from 10 or 15 uranium juniors to several hundred. Now, I haven't done the count, but I'm going to, and I bet we're under 20, for sure under 30 active uranium juniors. Some of those companies now are just about to go into production within a year or two. They're way less risky now than when they were much higher priced. So that's the opportunity, and I think that's the challenge for investors is, the peak, what follows that initial peak is called the trough of disillusionment, and with good reason. The share prices drop, you're like, oh, what a bad idea investing in uranium stocks was. And the challenge is that human progress, building mines and things, progresses on a pretty linear scale. You can only, you have to do one step, then the next, then the next. That timeline can be 10 or 15 years. That's forever in stock market time. That's infinite time. And the challenge for investors is to find the spots where it's a good time to invest. And usually the best times to invest are the times when you don't feel like doing it. The times when we're excited and whoa, all these stocks have gone up, this is the best time ever, is the worst time to get involved. So I found the hype curve model to be a useful tool for me, just to remind myself that there are some really good bargains out there. The world, okay, if the world comes to an end, it doesn't matter. But assuming, if you're an optimist like me, I don't think the world's going to end. Demand for raw materials will be there, and whether the price is high or low doesn't really matter. I actually think eventually prices will get lower because we're really smart people and we have really cool technology, but it takes 10 or 15 years to all the cool technology to extract resources to come into play. So for the next little while, we're still in a commodity bull market. Just remember, commodity bull markets end. Right, and it's usually because of technology and time.
Now, your comments in terms of the hype curve investing. Last year we had a lot of volatility. What do you think is coming up next year, and how is that related to your hype curve investing model?
There's a lot of external factors, but I would say that in terms of the small companies exhibiting here, I think we're going to see a little more interest, a little more activity. There's a lot of money that was craving safety, but the safe money has no return. It's not bad. Safety's not bad. Not losing money is good. But I think that money is going to start looking for a return. And if investments, if you want to get a return, you're going to have to invest it in some kind of business. And I think that's a big positive, is we're going to start to see money come back into the markets.
And on the resources side, specifically in terms of metals, is there a particular area that you're a fan of, or you see that things might be looking good, or just sort of across the board type expectations?
Well, anything for a buck, of course. We've seen some interesting, there's a lot of sort of potentially a hype bubble starting to brew in graphite stocks. Uranium stocks have had their hype, and now they're in that trough of disillusionment. So those are some more specialty metals that iron ore is interesting. I mean, that's a very long-term game, but there's some very big deposits in the Labrador Trough, and we've seen some good action there.
Well, thank you very much. Appreciate you being with us, Jim.
It's a pleasure.
High curve investing. Again, that's Jim Letourneau of the Big Picture Speculator. My name is Scott Gibson with Beneath the Surface. Thanks for being with us.
Thank you for watching Beneath the Surface with Scott Gibson. Stay tuned for more.